Welcome to this video from Kepsfield Academy. In this video, we will cover the two-stage DCF model, which we already introduced in one of our other videos. In this video, we will explain how to calculate the enterprise value and equity value of a company based on the discounted value of projected cash flows in our financial model. The two-stage discounted cash flow valuation is a widely used method for estimating the intrinsic value of a company or investment. This approach takes into consideration the time value of money and the risk associated with future cash flows. The two-stage DCF model is structured around two distinct phases, each of which captures different aspects of a company's financial performance. The first stage, known as the explicit forecast period, focuses on detailed near-term projections. The second stage deals with the estimation of the company's value beyond this near-term period. By incorporating both near-term and long-term perspectives, the two-stage DCF valuation provides a comprehensive framework for evaluating the intrinsic value of an investment, enabling investors to make informed decisions based on their analysis. To estimate the intrinsic value of the company, the present values of the free cash flows during the explicit forecast period and the present value of the terminal value are summed up to arrive at the enterprise value of the company. When we deduct net debt from the enterprise value, we arrive at the equity value of the company. The explicit forecast period refers to a specific time frame during which a company's cash flows are projected in detail. During this period, financial analysts create forecasts for the company's revenues, expenses, taxes, and other relevant financial metrics. These forecasts are often based on historical data, industry trends, and assumptions about the company's future growth and performance. The main objective of the explicit forecast period is to capture the company's near-term performance with as much accuracy as possible. Since the near future is generally more predictable than the distant future, financial analysts use this period to estimate cash flows with greater confidence. Determining the length of the explicit forecast period in a DCF valuation involves balancing several factors, including the company's stage of development, industry characteristics, data availability, and the analyst's expertise. Mature and stable companies in predictable industries may require shorter forecast periods, while fast-growing or early-stage companies in rapidly changing industries may need longer periods to capture growth potential. The quality of available data and the analyst's confidence in projections also play a crucial role. Ultimately, there is no one-size-fits-all approach, but a common practice is to use a forecast period ranging from 5 to 10 years. The key is striking a balance between capturing near-term performance in detail and recognizing the inherent uncertainties of projecting cash flows too far into the future. After the explicit forecast period, estimating cash flows becomes more challenging due to the increased uncertainty. To account for this, analysts use the concept of terminal value. Terminal value represents the present value of all future cash flows beyond the explicit forecast period, assuming a constant growth rate, or perpetuity, or a decline to zero, liquidation. There are two main methods to calculate the terminal value: the perpetuity growth model and the exit multiple method. The perpetuity method assumes that the company's free cash flows will grow at a constant rate indefinitely. The terminal value is calculated using the formula free cash flow in the last year of the explicit forecast period multiplied by 1 plus the expected constant growth rate divided by the weighted average cost of capital minus the constant growth rate. When selecting an appropriate terminal value growth rate for the perpetuity model in a DCF valuation, it's important to consider factors such as the long-term growth prospects of the company, the industry's expected growth rate, and macroeconomic conditions. The chosen growth rate should be conservative and generally lower than the long-term average GDP growth rate, as it's unrealistic to assume a company can outgrow the overall economy indefinitely. Additionally, it's crucial to assess the sustainability of the company's competitive advantage, its ability to maintain or expand market share, or any potential risks or disruptions in the industry that may impact long-term performance. Finally, the terminal value growth rate should be consistent to the assumptions in the WACC. In practice, this means that the inflation assumptions in the terminal value growth rate should generally be aligned to the risk-free rate applied in the calculation of the WACC. The exit multiple method involves estimating the terminal value based on a multiple of financial metric, such as EBITDA, earnings before interest, taxes, depreciation, and amortization. The multiple is usually derived from comparable company analysis or industry norms. For example, if a company's EBITDA in the last year of the explicit forecast period is 100 million euros, and the industry's average EBITDA multiple is 8x, the terminal value would be calculated as 100 million euros times 8, which equals 800 million euros. This terminal value is then discounted back to the present value using the same discount rate applied to the cash flows during the explicit forecast period. Although it is possible to calculate the NPV of FCF by hand, this is never done in practice. The simplest way to arrive at the net present value of free cash flows to the firm is the NPV Excel function, where rate is the weighted average cost of capital, and values 1 to n are the free cash flows to the firm for the explicit forecast period. There are important assumptions made by the Excel. It is assumed that cash flows occur at regular intervals and at the end of the period. The latter is called year-end discounting and can arrive at an inaccurate NPV estimate. The free cash flows that happened before the end of each future period are discounted more than necessary, which lowers the overall net present value and results in an undervalued operating enterprise value. The Excel function XNPV allows the user to calculate cash flows occurring on specific dates. It's important to consider that the dates need to be saved in a date format in Excel for the formula to be able to discount them for an appropriate amount of time. This Excel function discounts daily. If we would like to use the midpoint discounting with the XNPV formula to still account for irregular cash flows, we determine dates to be a midpoint of a financial year. For example, July 1st for each period, and input such as an array. We will now perform a DCF valuation for a Valer using a two-stage DCF model. This example uses the forecasted financials derived from the case example in the animation on forecasting free cash flow. You can download all Excel files and models in the online learning environment of Kepsfield Academy. The following free cash flows are calculated for the explicit forecast period, which runs from 2023 to 2027. A Valer's cost of capital is 8%. The cost of capital is calculated as the weighted average between the company's cost of debt and equity. The growth rate used in the terminal value calculation is 2%, in line with the expected long-term inflation. The company's cash flows are equally distributed within the financial year. You are valuing the company per January 1st, 2023. Given the cash flow distribution and the valuation date, mid-year discounting is most accurate. First, we calculate the first stage. We discount each FCF by 1 plus WACC to the power of the number of future periods. We find that the cumulative present value of the cash flows in the explicit forecast period is 12,066,000 euro. Second, we calculate the terminal value. We assume that free cash flow will grow 2% in the terminal value year fiscal year 2028, resulting in a cash flow of 3,523,000 euro in the first year of the terminal value period. The enterprise value is the sum of the present value of the explicit forecast period and the terminal value. We find an enterprise value of €53,599,000, which is 9.3 times EBITDA fiscal year 2023. Want to fast-track your finance career? Explore our practical, comprehensive courses at www.kepsfield.com and accelerate your career today.